You might be a founder, an IR pro, or an investor, and you probably think your shareholder letter is a safe, polished piece of narrative. Think again. The SEC just pulled a rug. For the 2025-26 proxy season, the Division of Corporation Finance will largely stop issuing the informal, no-action responses that companies relied on to exclude disputed shareholder proposals. That single change turns shareholder letters, investor memos, and voluntary PX14A6G filings into higher risk, higher scrutiny pieces of evidence. And your wording, tone, and structure now determine whether you survive proxy season review or trigger a costly fight. Here's what I'll do in the next 12 minutes. Explain the new PX14A6G and Rule 14A8 landscape, show concrete wording and structural edits that reduce exclusion, and 14A9 risk, give 3 ready-to-use templates: a public company letter, a VC-facing startup memo, and a family office annual memo, and leave you with a 90-second IR pre-release run and 8 quick wording swaps that neutralize legal flags without killing persuasion. Quick disclaimer: this is educational only and not legal advice. This summarizes public SEC guidance and examples. Consult counsel for company-specific compliance. November 17, 2025 changed the playing field. The SEC's Division of Corporation Finance announced it will not substantively respond to most Rule 14A8 no-action requests for the 2025-2026 proxy season, other than a narrow exception for state law impropriety. That means you can no longer expect a staff no-action letter to be the safety valve for excluding a proposal or sanitizing aggressive proxy communications. But the SEC didn't eliminate PX14, a 6G, or enforcement risk. Staff guidance and new compliance documents clarified expectations about notice of exempt solicitation filings. Cover pages must come first. Ownership thresholds need clear disclosure, and everything remains subject to Rule 14A9, the anti-fraud rule. Voluntary PX14A6G filings can be used as a public record against you if they contain misstatements. You're not just writing a narrative anymore, you're creating a potential exhibit. So what changes day to day? 3 big shifts. First, the burden of proof moves from staff may bless exclusion to you must be able to demonstrate contemporaneous analysis and sources. Keep a file of the data, scripts, and sign-offs that produced any KPI. Second, tone and specificity matter more than ever. Ambiguous language words like "we believe" or "we expect" without context invites 14A9 claims. The staff can't vet every claim now, but shareholders, proxy advisors, and courts will. Third, voluntary PX14A6G filings are a double-edged sword. They can clarify intent and show transparency, but only if they follow the cover page rules and don't make sweeping, uncited promises. For example, a public company that excluded a shareholder proposal in past seasons and relied on a staff no-action letter now must document its exclusion rationale internally, include the required 14A8E notices at least 80 days before filing definitive proxies, and be prepared to defend the exclusion before investors or in litigation. If you can only do 5 things today, start here. Front-load purpose and audience. Begin every letter with a 1-sentence audience and purpose line. For example, this communication is an informational annual shareholder letter to holders of record as of the record date. It is not a solicitation for proxy votes. If you are soliciting, say so and prepare a PX14, a 6G cover page. Replace hedged ambiguous assertions with time-bound sourced statements. Swap "we believe" for "as of the stated date. Our analysis shows fact." Cite the data or model. Put all calculations in a single appendix. Show the formula, the period, and the raw numbers so readers can answer, "How did you get that?" in one place. Add a short, tailored forward-looking safe harbor that mirrors SEC model language and identifies the key assumptions. And if you file PX14A6G voluntarily, put the formal cover information required by Rule 14A103 before any commentary and disclose ownership if you're near the $5 million threshold. One quick test. If a lawyer could ask, "Where did you get that number?" and you can't point to a dated source in under 30 seconds, edit it. Now, 3 practical templates you can adapt immediately. First, a public company annual shareholder letter designed to be PX14A6G safe. Start with audience and purpose. An explicit line that this letter is to holders of record as of the record date and is informational, not a solicitation. Follow with a tight executive summary of 2 paragraphs stating reported results, key KPIs, and citations. For example, revenue $X million, year over year, plus 12% calculation method in Appendix A. For governance or leadership transition, cite effective dates and attribute sections so readers know who authored each part. Include a short, forward-looking safe harbor paragraph with key assumptions. Put KPI formulas, data sources, and timestamps in Appendix A. If you choose to file PX14A6G voluntarily, put the cover page first with ownership and solicitation status before any commentary. Second, a growth startup memo to VCs that's short, persuasive, and defensible. Open with purpose. An update and a clear request, such as an informational update. We will shortly request approval for the listed action and outline the ask below. Present top-line traction as 3 concise KPIs with dates and raw counts, and point investors to the data room. Clearly label the request with the timeline and any vote threshold. List 3 specific operational risks with mitigation steps. Put data queries and screenshots in an appendix. Keep tone direct, and always say, based on current data through the stated date. Third, a family office annual memo that is formal but plain. Start with a framing line that the memo is informational to family principals and not a solicitation. Report portfolio performance versus benchmark and include a calculation appendix. List material decisions with dates, votes, and rationale. Describe the liquidity plan with specific time windows and targets. Make it explicit whether directors are asking for family action. These templates are intentionally short up front, with legal and methodological details buried in appendices for clarity and traceability. Here is a 90-second IR pre-release run you can use with CEO and counsel before publishing. First, ask whether this is a solicitation under Rule 14, a 1. If yes, prepare the PX14A6G cover page before any commentary. Second, check for material forward-looking statements and, if present, add secant-style safe harbor language and list the key assumptions. Third, verify that all facts are numerically sourced and that methods are included in an appendix. If not, add sources now. Fourth, confirm any comparative or market claims have verified benchmarks and time periods. Fifth, for statements about pending proposals or potential exclusions, attach contemporaneous legal rationale and note the 14A8 notice date, which should be at least 80 days before the definitive filing. Sixth, ensure counsel has reviewed the draft for Rule 14A9 and PX14, a 6G cover compliance. Seventh, run a tone audit applying the 8 wording swaps I'll mention next. Finally, secure a named reputational owner's sign-off that facts are accurate and sources are attached, save the final draft in version control, and timestamp that file. If you can't finish this run in 90 seconds, cut content, not accuracy. 8 wording swaps that neutralize legal flags while preserving persuasion. Swap an unqualified will for we expect, based on stated assumptions, that. Replace market will with based on current market data. Through the stated date, our view is. Change undervalued to trades below our discounted cash flow based estimate of intrinsic value with the model in an appendix. Replace guarantee with we aim to or we intend to. Change we are confident to our analysis shows the metric as detailed in the appendix. Convert superlatives like best or only into comparative metrics with sources. For example, top quartile versus peers, based on the cited data. Turn passive legal hedges, such as it is believed, into attributable statements, like management estimates, supported by the cited data, and transform vague ESG claims, like lead in ESG, into concrete KPIs and timeframes. For example, reduced Scope 1 emissions by 18% in 2025 versus a 2023 baseline, with the methodology described in the appendix. Often, one swap saves you more time and money than a long boilerplate. A quick practical example. Berkshire's communications shift shows the value of structure and attribution. As leadership became more distributed, the letters moved from a single author, folksy voice, to clearly attributed sections that identify who wrote what and why decisions were made.